What's going on? Alex here, and today I'm answering your tax questions from Reddit. And this question has to do with whether making more money may lead to you ending up behind in terms of your take-home pay due to the higher tax brackets that you'd be exposed to. Let's take a look. All right, so this question comes from McCrane Chair. What puts me in a new tax bracket? Is all the overtime worth it? Currently, I'm at $18 an hour plus your typical 1.5 time overtime rate. Starting this last week, we get an extra $20 for each hour of overtime. Raking it in, I love it. Is it worth working 12-hour days, 7 days a week, or am I getting screwed? How is the extra bonus money taxed? Is it truly 40% off the top? I don't plan on working more than over 40 hours after the next few weeks. It'll only be for the next 3 weeks or so. Is it worth it to make the extra money, or am I not really getting extra money? Now, this issue of ending up with less when you make more money due to taxes, this is a fairly common misconception, and I don't know where it comes from, just mathematically. So we're going to look into this a little bit. It's not the first time I've heard this, and again, what do I know? I'm just a lowly CPA, but for me, the math never works in terms of making more money being a bad thing because of taxes. At the end of the day, you still end up with more money, and more money is always good. I went to business school, and that's what I learned. So let's dig into this a bit further and try to understand it a bit more. Now, the tax rates are a good place to start. And we have tax brackets in the United States, right? So you can think of it as layers of an onion. There's going to be the first layer that's taxed at a certain rate. Then the layer above that is going to be taxed at a different rate, while this first layer is still being taxed at that first rate. Third layer at the third rate, and so forth, like layers of an onion. Now, if we look at the 2021 tax brackets, we can see them for the single filing status. They're different for each filing status. And you can see that there are different tax rates being 10%, 12%, 22%, and so forth based on the taxable income. Not total income, not AGI or adjusted gross income, but taxable income. It's a very specific number on the Form 1040, which is the personal tax return. You can see the tax rates are being denoted here in the third column, and you'll see it's 10% of taxable income. Then you have the second layer being 9951 to 40525. Now we're talking about the 12% rate. So what that means is if your taxable income is, let's say, $50,000, you're going to get some of that income being taxed at 10% up to $9,950. The amount from $9,951 up to $40,525 is going to be taxed at 12%. Then the amount from $40,526 to the $50,000, that's going to be taxed at 22%. And this number over here, this tax rate, is known as your marginal tax rate, which means that it's the highest rate that you're exposed to. But notice it's not the total tax rate that you're going to pay, because we just discussed that this layer of the onion right here, this 22%, just applies to the taxable income above the $40,526. It does not apply to the income going from 9951 to the 4525, and it doesn't apply to the income below that. All right, so your marginal tax rate in this case is 22%, but your effective tax rate is going to be lower based on the fact that there are some lower tax brackets involved. Again, you can't skip layers of the onion, but you have to incorporate all of the lower layers in figuring out what your actual tax liability is when all is said and done. The important thing to separate here is the marginal rate, which is the top tax rate that you're exposed to, from your effective tax rate. And I'm going to show you how that dynamic works in a bit more detail when we look at the tax return. So here is a Form 1040, and all we're going to do for this return is add in $80,000 of interest income. This could be wages, this could be dividends, but I'm choosing interest income just to keep it nice and simple so we can see the effects on the return. So we see the taxable interest being $80,000, and over here you'll see total income, which requires that you add up most of these lines here to get this total income figure. So let's take a look. We've got wages, salaries, tips, all the income from W-2 essentially would end up on line 1. Then you have the taxable interest, ordinary dividends, qualified dividends. The IRA distributions would also play into it. Taxable Social Security benefits can also play into it, capital gains and so forth. So once all that's taken into account, we have total income, which in this case, being that's a simple return, is still $80,000. Then you have adjustments to income. All right. And these come from Schedule 1. You could see some of them laid out here. We're not going to get too in depth on this today, but going back to the 1040, we see that after we apply those adjustments to income, we get to adjusted gross income. So we went from total income, we take out the adjustments, and then you arrive at AGI, or adjusted gross income. Then it's the higher of typically your standard deduction or your itemized deduction. In this case, for a single filer in 2021, the standard deduction is $12,550. We take that out. And where does our taxable income end up? This is the amount on which those tax brackets are based. This ends up being $67,450. All right. So let's take a look at our tax brackets again and see where that lands us. So $67,450 looks like we'll end up right in the middle of this 22% marginal tax rate. Let's see if the software is reflecting that. Going to the general info page of this return, we could see that the tax rates are denoted here. We have marginal and effective. This goes back to what I was discussing a few minutes ago. Now, the federal rate is 22%, which matches what we identified here, where the marginal rate is the highest rate that you're exposed to. In this case, it's that 22% amount. Effective rate, though, is 15.7%. How does that work? Well, going back to what we discussed, your effective rate is essentially a blend of the income subject to your marginal tax bracket and all of the lower tax brackets that you may be subject to. Let's see if we can recalculate that effective rate on this return. All right, so going back to the 1040, what I would do in this case is take the total tax amount, we got 10,593, divided by the taxable income, okay, which is 67,450. So if we multiply that by 100, let's see if that matches. So we've got the effective rate of 15.7, which you can see here. So the distinction between the marginal and effective rate is really, if you were to ask, what is the most that I'm paying for every dollar of income that I'm receiving? That's the marginal rate. That's this 22%. So each additional dollar that this taxpayer is going to receive is going to be taxed at this 22% rate until what? Well, it's only going to be taxed at 22% until you hit the next tax bracket, which is 24%. All right. And that's going to happen at $86,376 of taxable income. All right. So if you're asking, what am I going to be taxed on each additional dollar? It's your marginal rate until you hit the next tax bracket. If you're asking overall, if we were to take all of my income and all of the taxes that I'm paying just at the federal level, what is the effective tax rate? Which means that if I have this much tax at one rate and then this much tax at another rate, this much tax at yet another rate, all of that put together, where does that land me? And in this case, your effective tax rate is 15.7%. So overall, when all of this is said and done, that's what every dollar is being taxed at, given the circumstances we've discussed here. So hopefully that helps shed some light on the difference between the marginal rate and the effective rate. But more importantly, hopefully this adds some light on this question here, because you'll notice the effective rate and the marginal rate, while they're arguably high, 22%, 15.7, they're much less than 100%, which means that as you make the additional income, you're going to end up ahead because you're still going to have money that you're taking home, and there's no way that you're not going to be making extra money. Hopefully this answers the question here. Basically, it is certainly worth it to make more money, especially if you're making the 1.5 time overtime rate plus $20 on top of it. I say go for it. I hope McCrane's chair, this answers the question. And if you're watching this video and you're enjoying yourself, you're finding value from this information, feel free to beat up that like button because it helps the algorithm and all that good stuff. And if you're not subscribed, subscribe right now. It's free. And you can always change your mind later. We have the most friendly return policy you could think of. And I also see that a lot of you don't have the notification bell rung. So hit that bad boy too. We're going to be uploading a lot more content. It's going to be a beautiful thing. With that, hopefully this was helpful. Thanks for watching.